So I would say that like that would be the biggest thing is just
Welcome to Building Wealth Through Real Estate. If you invest or desire to invest in real estate, then this show is exactly what you need. And here's why. We all know that the number one thing that you should be doing as an investor is networking. Your network equals your net worth. But how can you use this to your advantage? Well, firstly, take notes. Listen to what the guests have to say. If you're a new investor, you can learn from the mistakes that they've made, the experiences that they've gone through, and learn how they think. If you're an experienced investor, you could see strategies that they may be implementing that you haven't thought of using yourself. Now, secondly, you may have questions, and if you do, great. Put them in the comment section down below, and this way we can be sure to get those questions answered for you. And thirdly, there's a ton of information out there, but I found that most of it is relevant to the US, and it's hard to try and take out and extract and see what's relevant to your area. So all of the guests that I'll be interviewing are Canadian investors. So if you invest in Canada, if you're interested in investing in Canada, then this show is exactly what you need. Joining us today is Mr. Adrian Nedelec. Adrian, could you tell our listeners a little bit about yourself, how you got started, and your journey to this point?
awesome. Thank you so much, El Ray, for having me. I really appreciate the invite, and yeah, I've been seeing what you've been doing in the real estate community. So we appreciate you giving back to the community. It's awesome to have you there. So yeah, my name is Adrian Nedelec. I wear a lot of hats. So I'm a real estate investor. I started out as a real estate investor. I'm a realtor as well. So I'm an agent here focusing on investment properties. I'm a partner with James Canal at Mogul Realty Group. So James manages our Vancouver office and oversees big picture. And I manage our Edmonton office, and my title there is sales manager. And then beyond real estate, I also have a beautiful wife and a son who's going to be 1 year old. And I'm a big car enthusiast, and I have a lot of hobbies and things that keep me busy. So that's me kind of in a nutshell. And you asked, how did I get started? So that's obviously that's a big question, and I'll dive into it, and how I kind of got started in real estate investing. So I was in university finishing my Bachelor of Commerce degree, and I didn't really know what I wanted to do. When you go into uh, any sort of business, you have so many options. They don't really give you one direction that you can focus in, unless you mentioned accounting and focusing on that niche. For me, I looked at management. That was the major that I was shooting for. So I didn't really have an idea of where I wanted to go. So out of university, I decided that I'm just going to get a sales job. I'm going to start in corporate world and figure out where that takes me. And meanwhile, I always was looking at hobbies and things that interested me. And it's always so funny because I feel like a lot of people get started this way, but honestly, watching HGTV, I had a man crush on Scott McGilvery. I loved income property, and I thought it was so different and cool that all the people that were on the show they weren't flipping the property. It wasn't continuous that they had to continue flipping. It was all about them reducing their expenses and putting some sweat equity into the property. So I thought that was just so cool. I loved the renovation part of it. I loved just putting in that work. And it was just an interest to me. I didn't really do anything to pursue it at that point. I'm driving home, and my girlfriend, now wife, called me, and she said, "Hey, I just heard on the radio that Scott McGilvery is coming to town." I said, "No way! I have to go see him." So I called my dad. I told him, I said, "Hey, Dad, what are you free this weekend? You want to come check out this thing?" And he's like, "Yeah, let's do it." So we ended up going to the seminar, and I always laugh because the way that they set it up, it's so smart. So they give you just like, a teensy bit of information, and they say it's about a 2-hour session. They bring Scott McGilvery there, and they give you like all this information. You're like, I want more, I want more. And they sell you about a $500 weekend course for two people. Sign up for the weekend course, and they give you just enough information to be dangerous, but not enough to feel like you can pull the trigger on anything. And then Sunday, so it's like Friday night, Saturday night, and then Sunday. And Sunday's the big pitch day. They want you to sign up for coaching. And so this was through the Keyspire organization. And this was back in 2013 when it was actually called Lifetime Wealth Academy. So that's really how it got started. Is I went to a weekend seminar, and then it kind of, we signed up, and that's where it all began.
And your first property that you jumped into, what was that?
Yeah, so the first property, so I was young. I was 24 at the time. I bought it in 2014. So um, what we ended up doing was, it was so funny. I remember, because now I'm a realtor, and I would hate working with me as a client because I had very little specifics. I just said, I want a house with a basement suite. Doesn't have to be legal. It can be illegal. And I want a garage, which was very important to me, and somewhere in a mature neighborhood. And they said, well, what part of the city do you want to be in? I'm like, I don't know. And so I gave them no specifics. And this was back. And so I bought the property in June of 2014, started looking maybe a month, 2 months prior to that. And the market was crazy. We would go look at houses, and everything that we saw was just flying off the shelf. You had to make a decision essentially as soon as you left that property, whether you were going to write an offer on it or not. So we probably did a couple rounds of showings, and what we ended up falling into was about 1,000 square foot bungalow with an illegal suite in the Allendale area, which is kind of in the university district. And it was 2 bedrooms up, 1 bedroom down, and the bedroom or the basement suite was pretty decent. There was nothing wrong with it, and the main floor had been like slightly renovated enough that we could get some decent rent out of it. So that was my first property. Was a two up, one down, illegally suited property in the Allendale community.
Okay. And how did you sort of go from there? How did you scale from there? What's your journey been like since that?
Yeah, so because I was fairly young at that point, I was making, call it 50,000 a year in a sales job. That was my salary, and then I needed 2 years of commission history in order for the banks to look at me. So the properties that I originally started to look at were, I think I was pre-approved for like 350,000, and at that point I had to figure out what kind of property I wanted. So I ended up bringing my dad along in the whole process. And once we signed up for Keyspire, he stopped coming to the meetings, and it was all through me. It was all on me. So from there, he pre-approved, or he co-signed for me on my first property, and I loved it. I was doing the house hacking, and so I knew that I wanted to grow my portfolio, and I looked to people around me to help do that. So my parents were not really in real estate. Back in 2008, they ended up buying a condo that when that market was just going crazy, most people just assume that it's going to be hard to get back into the market when something is kind of peaks out. So they knew a builder. They ended up buying a townhouse. They had it rented, and they weren't happy with their property management. So as soon as I got my property, it just gave me that experience to say, hey, I can kind of do this on the side. I can help. I can joint venture. So I actually joint ventured with my parents on that property with 2008. We made an agreement on that property that I would manage it for free, and any appreciation that we received from what they purchased it to, whenever we sell, we would split that 50-50. So that was the first kind of next jump into it. And then shortly after I bought my property, we started looking, and then my dad and said, hey, he was coming to the Key Spire events, and he said, let's do this real estate investing thing. So we ended up buying a legally suited house in Kenilworth, and we made an agreement on that one. Your typical kind of RAIN joint venture 50-50 split. So he comes in with his initial investment. We buy the property. I'm the working partner, and then manage it and do all that stuff. So that's how I kind of got started on that. And then from there, my parents were, we're good on real estate, and I had to continue growing my portfolio. So I went to every single meetup events, every single real estate events I could get my hands on, and just started talking to people. And we met a joint venture partner and did a couple burrs. And then from there, we just continued growing. I bought some properties through myself personally as I grew in my career. And then it moved into just bigger and bigger. And the last acquisition that we did was a 24 unit apartment building where we raised about $1 million in capital, and closed on that about a year and a half, 2 years ago.
I love that. I love that growth. And I want to dive in deeper, but I think that gives a good overview on your journey to this point. Now, currently, what strategy are you pursuing?
So yeah, it's kind of funny because so the first property I ever purchased was in Allendale, and then we lived on a street, a beautiful street, and my wife wanted to buy a property. We knew that we eventually moved from the basement, we moved upstairs, and we made like small strides ourselves, just really trying to reduce our monthly expenses so we can, afford more real estate and have a lifestyle that we wanted to live. And our neighbor had, she was a grandma, and she had a house that was basically original. And her sister and her husband lived next door to her. And she unfortunately passed away, but we became really good friends with her sister and her husband, who were, two doors down from the original house that we purchased. So after she passed, we approached them and said, would we be able to purchase her house? And we got a third party appraisal, made a deal with them, did a purchase plus improvements, renovated the house, and then it had a basement suite existing. So we moved into the main floor and then rented out the basement. And I've always wanted to do some development projects. And so I love the area we are. It's close, it's central, it kind of has all of the things that you look for as an investor. And so we ended up seeing a fourplex on our block that went up for sale. We found some joint venture partners, we partnered with them, we purchased the fourplex. So my current strategy right now is I am trying to buy up every house on our block, from basically the alleyway or from our existing house to the corner lots. And the plan is just like slow, steady, and just pick away when they come available. And the plan is just hold them. Every single house cash flows on its own, and eventually just gives us opportunities to either rezone or redevelop or sell as kind of a portfolio in the future.
That's a great idea. It's pretty unique. Of all the guests I've had, I haven't had that one yet though. But when you are looking at these properties, like what? Well, you have this narrowed down to a specific, very very specific location. But in general, when you're looking at investment properties, what boxes are you looking to check when a potential deal crosses your path?
Yeah, I mean that's a great question. It's always something that investors struggle with, right? And I often I have these conversations with investors, and so with the tables turned, it's always interesting to think about it from this side. But for me, so obviously I have, so just diving into so that, and then I'm always looking for multifamily buildings and things that make sense. But on the houses specifically, I'm a big location based investor. With location comes tenant profile, and tenant profile really tends to be your bread and your butter with the houses that you have and the properties that you have. So for me, I kind of co-manage a lot of the properties that we have, and I really want to deal with a specific type of tenant profile. And so when I'm looking at a house, it's location, and I mean, we're narrowed down right to a street. So that kind of checks that box. And then I look at all the other things. When I walk into a property, would I want to live there? I mean, not just me today, but me as call it a 21-year-old kid in university to, as I move through that lifestyle or that age range, would I want to live there at any point? And, since I basically moved out of my family home. So those are things that I look for. And then obviously the fundamentals, does it cash flow? Does it cover its expenses? Right now we're in such an interesting time with interest rates going up and everything impacting us. We're in this interesting time. So trying to find deals that make sense and cash flow, you kind of have to get a little creative in the ways that you're trying to find that. So right now what I'm looking for is properties like kind of what I mentioned, and they're quite specific. And I think on like in this situation, for example, you really want to, like, for me, I'm okay overpaying a little bit because I have a bigger plan and a bigger picture. So it may not make sense for somebody else who might not have a development project in the future. But if I'm looking for anything else, that's kind of the key things I'm focusing on.
Yeah, that makes sense. That makes sense. And your strategy is a little more long-term thinking than right now. Um, I get that for sure. Now, you touched on this when you ran through your journey, but when you reached that sort of inevitable point of running out of capital and needing to raise money, what was that initial experience like? What were like some challenges that you faced, and how did you get past them? I know you said you went to sort of every meetup that you could, you know, focused on the networking aspect, but what were the challenges associated with getting that first, raising that first bit of money, getting that first money partner?
Yeah. Um, it's interesting because I think back to a story where you when you go to those networking events, you're putting yourself out there and you have an intention, right? You want to meet people, but your intention is to find money partners. And you're really putting yourself out there, and it's nerve wracking. And for myself, I'm more of an introvert. We discussed this a while back, Ellery, and for me, getting outside and going to those networking events is a little unnatural for me. I'm good at it. I have to put that face on. So really, just like pushing yourself to go to those events was step one. That was kind of the biggest hurdle. Was, you're in the comfort of your house. You don't have to really go if you don't want to. No one's holding you accountable, but you know that it's benefit for you to go to those events and to meet those people. So the story that I have, and I actually did a Mogul Mastermind presentation a couple years back about it, but I wanted to find, I didn't really want to do the real estate investing journey alone. So I ended up partnering with a friend of mine who had a lot of business experience. He operated a lot of businesses himself. And so I said, hey man, this is what I'm doing. I would love to have somebody to come to networking events with. I would love for you to partner with me, and let's see if we can, raise some capital and do our thing. And so we made it a mission, and that's what really pushed me to have that accountability. Was that, it's kind of like that workout partner situation. No one's going to tell you to go to the gym at 5 a.m., but if your partner is going to be there, you gotta follow suit. So we made a pact that we were going to go to all these events. We were also working at the same company too, which made it easy because some of these events would happen during the day and the afternoons and things like that. And we knew that we had to chat with people and get outside of our comfort zone. What I find too often, people love to just sit in their circles, sit with the people that they know. So we intentionally said, okay, you sit at one end, I'll sit at the other end, and let's figure this out. So back in the day when Keyspire used to do their monthly meetings, what we I think it was a 90-day meeting. What they did is they had stickers on people's name tags, and it was, are you a working partner? Are you a contractor or are you a money partner? And they were all about connecting and really just bringing people together. And it gave you, opportunity to just chat with people because you looked at their name tag. And so this one was a little bit different because instead of just having stickers, they actually just said, "Hey, who's a working partner? Raise your hand." And so, everyone, like half the room raised their hands. And they said, "Okay, who's a contractor?" And a couple of people raised their hand. And then they said, who's a money partner who's looking to lend their money out?" And everyone's kind of just like scanning the room to see if there's anybody. And Matt and myself, we looked and we saw these two people, and they kind of like briefly raised their hands, and they kind of felt it was awkward, and they dropped their hands pretty quick. And so Matt and I kind of locked eyes, and we knew that we had to go chat with these people. And so networking break starts, people are grabbing coffee, and they're getting chatted up with different people, and we're about to go and chat with them. We find them, we kind of like corner them in the coffee area, and then they start ringing the bell, and we briefly shook hands, and we had no opportunity to really have a conversation with them. And so then we're Matt and I were both like, "Oh man, we got to figure this out. We got to meet these people." And that was the last networking event, or not networking break for the event. And so the event ends. They're chatting with other people. We're trying to get in there, and we lose sight of them. And we're like, "Oh no, we missed our opportunity. It's gone." So Matt ran outside. He ran to the parking lot, tried to find where they went, and we couldn't find them. And so we're walking back into the venue, and they're actually just walking to their car. So at that point, we were able to have a meet and greet, got their cards, and long story short, we ended up meeting them for coffee. We had a bunch of mutual connections, and our families knew each other, and it just happened, and it was organic. So it was just, I mean, the biggest hurdle was getting out in front of people and having that initial conversation. It's, you just overanalyze so much that it's so hard to really just do it.
Absolutely. I completely agree. And that's the hardest bit, is that getting out of your comfort zone. So I think having an accountability partner definitely helps keep you in check. You help keep each other in check there. And it might make it a little easier and a little less daunting going out on your own, but then you still have to. I like the idea that you guys sort of broke out, separated into the room, go to different tables, meet up with different people, as opposed to sticking together and somewhat just staying straddling that line of the comfort zone. So I really like that. Many new investors find, this part of investing to be daunting, which is generally the case. If you're looking at the starting point and the end result. But I find that if you're able to focus like one step at a time, your path becomes clearer and taking action becomes a whole lot easier. Could you perhaps break down the process into like actionable steps that people can focus on when it comes to raising capital?
Of course, yeah. Yeah, so actionable steps, I mean, I think that having a goal is always important. So, but before you even get to that point, and I mean, we're talking about raising capital, and you're dealing with other people's money. So, the thing that I often tell people is you need to go out and get experience first. And the way that I felt comfortable with other people's money was the fact that I was being able to build a system and build everything on my own. And I was gambling with my own money first before ever bringing anybody else's capital into the equation. So I think number one is go and get that experience first. And a lot of people will say, "Well, I don't have the money. I don't have the means to buy a property and to test it out and do all those things." But there's so many other ways. I would say number one would be getting your own property. That would be the best way to do it. But if you don't have the means to do it, that's okay. You can get involved and work through other steps first. So one of the suggestions I always say is there's a lot of property managers out there, and property management, when you're thinking about becoming a working partner, property management kind of tends to be one of the biggest pieces, or can be one of the biggest pieces in the joint venture. And so learning that trade, learning that skill, you can do that and volunteer and help and ask for coaching or mentorship from someone without earning any income, and people will love to help and share that knowledge. So I would say, one, get that experience. That's going to be more than anything the most valuable thing that you can do. Number two, action step, I would say, is make a game plan. Nobody wants to go down the road and have no roadmap to follow. So if you're just kind of scattered and not know where to go, then you're going to lose sight of exactly where you're going. And again, I mean, this is where I stress it so much, is you're using other people's money. You're joint venturing in a partnership, and you really want to be cautious of using those people's money. And then once you have a game plan, break down the steps in how you're going to get that acquired. For me, I was like, I'm going to lean into as many events as possible. That's where I'm going to start with my circle. So I started events was, sorry, actually number two. For me, number one was friends and family. Who can trust you the most and who believes in you the most? So for me, it was my family. So my dad, they had rental properties before. Their property manager wasn't doing great, and so that's how I jumped into it, and it gave me that confidence because it wasn't my money I was using at the point, it was his. And losing his respect and losing that was such a big deal to me. So I really wanted to make sure that I focused on that. And then I think a lot of times what happens is people don't are not specific enough in what they want to do. They're looking at any deal or anything that's going to make sense, but then they shoot too broad. It's like me when I first started looking for a property. I'm like, I didn't even give any suggestions of where to look. But if I narrowed down and went specific, similar to my investing strategy right now, then that's like the biggest thing in order for them to continue growing and set those goals. I think those goals are going to be, very, very important, and break those goals down instead of just being like, I want to raise $1 million. It's similar to us in real estate. When we talk to an agent, it's like, cool, you want to do 3 or 4 deals a month. That's great. But what are those steps that it's going to take you in order to do that? You got to book meetings. You're probably going to only close 50% of the meetings that you have. Okay, break it down. So now you got to do 8 meetings a week. And how many phone calls do you need to do? So all those steps, you can utilize that in any sort of goal that you're chasing, is just by breaking it down and making it a small goal instead of this huge daunting goal.
Absolutely, I completely agree, and it makes it a lot easy to tackle it. You're chewing it one piece at a time, versus looking at that end goal and just focusing on that, is breaking down those steps. And I think you did a great job at that. You need that credibility, you need the experience, or else why is anybody going to want to give you their hard-earned money? So try and get some sort of experience first, and then you need to be clear on what it is you're looking for, how you plan on going about it before you can present it to anyone too. So I love those tips. I love them. Now, I know you went to as much networking events as you possibly could. Where are some good places for people to try and find joint venture partners? Do you recommend that they just keep it within the real estate networking events, or can they branch outside of those events? Like, what ideas do you have for people when it comes to actually putting themselves out there beyond just their inner circle?
100%. That's a great question. I think, and you have to get creative. You have to get creative in where you're going to go. So, I mean, any sort of meetup events, you can use Meetup. But one of the simplest ways of finding joint venture partners is just having conversations in every day. You're at work, water cooler chats. One of the things that, and this again, we talk about this in with our realtors as well, having those conversations, and you're planting the seed. It's like you're going fishing, you're throwing your line in. If there's a nibble, great. You're going to see if you can reel them in. If there's no nibble, you move on with your conversation, you cast again, and you keep trying. So the nice thing about our industry is we're talking about real estate. Everyone has to like rent a house, own a house, live in a house. People need shelter. And so it's relatable to 99.9% of the population that like people are talking about housing, people are talking about that. So you can look at some of those things as part of conversation starters. And, people always talk about Dale Carnegie, looking at some of the steps and ways to engage with individuals. So for me, it was just about having conversations. I love asking questions. I love really listening to people and understanding where they're coming from. And my wife always bugs me because I'll meet a stranger, I'll meet someone at a wedding, and we just get into these very personal conversations. And she's like, "How did you do that?" I'm like, "I'm just listening and asking questions." And I think if you're a joint venture partner and you're looking for capital, ask people questions, understand what they want, and opportunities will arise the more you can do that. So I would say that like that would be the biggest thing, is just bring up those conversations with people that you know, people that you don't know, anybody, and then continue going to networking events. And as you build and you have great success with joint venture partners, it's like that referral network in any sort of business you have. If it worked out and you hit the numbers that you've pitched or proposed to individuals, it's great. People are going to refer you to their friends and their family, and it's a very organic situation. If you suck and you didn't do great, and you didn't hit your numbers, and you didn't really follow through with what you're going to say, it's going to speak for itself and it's not going to happen for you.
Yeah, I agree. I love your response there and your analogy. Um, if you don't throw your line into the water, you're not going to catch anything, you know. So I think you need to get good at doing that, because you can look down and try and see if there's anything to catch there, but you won't really know unless you're actually putting your line in the water. So you just need to practice doing that, get good at doing that, and with repetition, you'll sort of increase your skills. So even if you're not someone who's typically outgoing or social or an extrovert or easy to talk to, just by doing that, I think you'll hone in on that skill in and of itself. So that's a great starting point. Just trying to do it wherever you can with any interaction that you have, and then just go to as many networking functions and possibilities. Just opens up doors to meeting new people so that you can put your line out there. So I love that. And like you say, be creative, and your reputation is everything. And the best advertising or marketing you can do for yourself is referrals. So have integrity and be true to what you say you're going to do. And over the long term, it'll be less of you actively going out to try and find these partners, because you've built these relationships. You have referrals coming in, and I love that response though. How would you recommend investors go about approaching possible joint venture partners to try and build the trust and relationship to get to the stage where they can get their attention and present the investment opportunities to them? Now, I know you've touched on this, asking questions, learning more about them, sort of building that relationship. Do you have any advice for people taking it from that first bit where they throw the line out there, get to know them a little, to the point where that person will actually take them seriously enough to book that coffee meeting with them, to allow you to actually present your offer to them? How do you build that trust, build that credibility, and actually get an ear from them so that they can listen to what you have to say?
Yeah. Uh, it's so funny. When you're asking that question, there's so many like memories and things that are popping up in my mind. But for me, you have to start with number one, authenticity. I think being authentic from the start, and even having that conversation. If you're too salesy from the beginning, people are going to see right through that, and you're never even going to get to that opportunity of you know approaching them, pitching them, however you want to word it. But when you get to that point, and in Keyspire, Corey and Tiffany Young, from the Fearless Investor Group, they were a lot of the coaches, and their stories is pretty cool, very incredible. And I remember them talking about their first joint venture conversation and sit down meeting. And it was very similar to ours, where, we had so many, like, I wanted to know every single thing. I was so worried about the numbers and the details and all those things. So I was over preparing for that part. And I'm not to downplay the fact of not knowing your numbers. I think that's an important, especially if you're um, pitching an individual or somebody who's very analytical and they want to know the numbers and their ROI and that sort of thing. But when Corey and Tiffany, they brought out, like, this was back, I think that they, most of their portfolio and their acquisitions started in 2002, back when you had binders and people would print things out. And I remember them talking about that. It was similar to us. We had a upgraded a couple of years and had a laptop and brought that with us, with spreadsheets and graphs and circles and all these things that we put together for knowing how a past investment went and what future investments would look like, and et cetera, et cetera. And we went to this meeting, our first joint venture meeting, and we were all nervous. We didn't know how the conversation was going to go. We didn't know what questions they were going to ask. So we wanted to be prepared with every single thing. And when we sat down, and what we realized is that conversation went, I would call it 10% into the numbers, 90% in just a conversation. And they wanted to know about us first and the business second. And I think once you gain that trust as the individual and you build that relationship, then everything else comes from that. So, I mean, as cliche as it sounds, it's always about building that relationship, but it's so true. It's so important. So for us, it was, about managing that relationship, building connections. Like for us, we found out we had very similar, like my dad and him was, they boxed together in the 70s. And then my business partner and his father-in-law they worked together. So there was all these connections that we never knew that were there. And that, again, that like really jump started our relationship. But if those weren't there, we're building that relationship on who we are as individuals and our family and all those things. So I think having that common ground and that understanding was number one. And then obviously they're investing a lot of money, so they want to know if you're credible. They want to know all those things. So that's where understanding your numbers and talking about the opportunity that's there and what you're building. And I find that having them understand kind of the goal that you have and where you're really wanting to take your joint venture and your real estate business, and if they're bought into the idea and they understand, they'll join in. They'll jump in. So for me, I mean, to kind of recap, all about the relationship first. Knowing your numbers are important, but build that relationship number one, and everything else will follow after that.
I love that. I love that. Absolutely, because people aren't going to listen to you if they don't trust you. No matter what numbers, what ROI you're showing them, what your goals are, why should they trust you? Anyone could put numbers on a spreadsheet. Anyone can make a fancy looking presentation, but you want them to be listening to you when you present. So I even like the order in which you laid it out, because that's sort of the flow of how the presentation would go, right? Is you would first speak to them, you'd first build that rapport, build that relationship, build the trust, and then you would move on to what the goals are, that sort of thing, and then move into the finer numbers, the finer details, and handle any questions they have along the way, as opposed to just jumping in. Hey, here's a presentation. This is what I'm going to do. These are our expected returns. Business, business, business. And nothing on the relationship end. So I love that. I think that's great advice. And although people may have heard it before, it's true. It's the only way that it works is building on that relationship. So it's definitely a relationships game. So what are some things they should try and steer clear from doing or adding to their presentation?
Yeah, projections are hard. I think that some people will over project in order for a deal to look good. Similar when we look at when we analyze a multifamily building, everything's based on cap rate. And so in those situations, you're reviewing the pro forma, and you have a couple terms and words floating around: actual, stabilized, estimated, projected, all of these words. And it's similar to, anytime you want to buy a property, you're like, okay, well, show me the financials. I don't care about your stabilized, your estimated, or projected. Show me the actuals. And I think in those cases, you definitely have to come, but you want to be realistic. And I think that if you overshoot the expectations from the beginning, it's doomed. So if you have a plan, let's say that we're buying a building or a property, and we're planning to raise rents. If it's super unrealistic that you're going to hit those numbers, now the the relationship is sort of tainted, because these expectations you gave your investors are so far fetched that it's never going to be possible. So I think it's better, instead of like just shooting it with, here's your projected info, best and worst case scenario, and like likely. So like worst, likely, and best, and then go through it. So you're not really giving one specific, here's what we're going to do, and these are the numbers you're going to hit. It's like, hey, this is like, shit hits the fan. This is what things are going to look like. And so if you're comfortable with that, then let's talk about, here's the kind of realistic situation. And if we're seeing the trends and everything that we're hoping for, this is kind of the best case scenario, and this is what we're hoping for. That's super important. So I would really leave out um, big, big expectations, because you're never going to hit them. And you don't really want to burn that bridge, because you want to do more deals with those people. Having joint venture partners that are consistent and who continue, investing in you, is the ones you want.
Oh, absolutely. I think that's an awesome answer. That's a great answer. Better than I honestly expected. I love that, because it's all about the long term relationship. It's not just about getting them to say yes then and there, and it's not worth the risk of sacrificing their trust in you, your integrity, if you're not able to deliver. I love the fact that you add in a range as well, worst case scenario, um, realistic, and best case scenario, so that if if it falls anywhere within the range, the expectations have been set. They still see you as being trustworthy, because this is what they signed up for, right? Um, so I love that. I love that. I think setting expectations is a crucial part of any interaction, and being able to set them accurately. So I think you hit the nail on the head there.
It's funny because, like, we work with a lot of investors in our real estate business as agents. And it's the chicken or the egg scenario, right? And so, do you get the property first and you find your joint venture partners after, or do you find your joint venture partners first and then you find your property? And so I think that, like, those conversations will be a little bit different. Of course, if you're looking for the property and then you try to find joint ventures after, I mean, it's very similar to what we see, like, a lot of wholesalers are doing, is they're tying up properties and then they're trying to push it off to another party or joint venture with somebody. I I like, that's fine, but for me, I'm a little bit more risk adverse when it comes to kind of analyzing the deal and doing all those things first. So I would like to set up like projections first and say, again, I'm using my previous experience and previous deals as kind of a benchmark, and then I'm setting my expectations from that point. So I always go with, let's get the joint venture people first. Let's get their partners in line first. We kind of call it, we can put them in the hopper, and then let's go find an opportunity. And for us, it's like, you don't want to go burning a bunch of time trying to find properties, getting them under contract, and then never closing on them, never committing to them. That's kind of the easiest way to burn relationships, especially with realtors and things like that. So because of that, and it was something that James taught me, was, I used him as a joint vent, or as my realtor when I was getting a joint venture partner, and it was something that he coached me on, and I really learned a lot from that, because I always thought that money will come if you have the right opportunity, which is true, but you really want the right partner before you have the right opportunity. And getting in bed with the wrong joint venture partner, if you're signing up a 5-year deal, it's a long time to be with somebody who is micromanaging you, and all those things. So, I mean, it's kind of a roundabout answer in the fact of like, what do I do when I analyze a property and what am I looking for? But I really want to be I want to be as transparent as possible. I want to understand the numbers. I think getting beyond it. If we're talking residential, it's fairly easy, because you can use rent faster to look at rents. You can get, call it, the last 12 months of utility bills, or average out from your other portfolios. You can look to see if you have a efficient furnace and windows and all those things that are going to cost you money and eventually go into your kind of expenses column and your income column, and talk about your cash flows and all that other stuff. Everybody is going to guess when it comes to your projections. And we typically have two projections when we're looking at talking about our 5-year ROI on a property. And that's market appreciation, and that's rental rate growth. Those are the two things that are out of your control that you're essentially projecting. And so being more conservative with those numbers, and again, like calling it the worst, likely and best case scenario, are going to be important. When we flip to the multifamily side, that's where it becomes, there's a lot more layers to analyzing the property and pitching it to investors. Of course, you have your projections, like your rental rate increases, you have your appreciation. But the nice thing is your building value is associated to your net operating income. So if you can do anything to become more efficient, it's when we look at the residential side, values are typically based on your comparable approach. You're looking at other properties similar to that one. Maybe an investor will pay a little bit more if it cash flows a bit more, but it's not like you can convince an appraiser of that. It's not like you can convince the market of that. They're going to look at your comps and say, this is what your property is worth. I don't care if you cash flow $100 or negative cash flow $100. Your property is based to the comparables around it. The nice thing about multifamily is you have the opportunity to really just grow that portfolio, or grow that asset by increasing your income, reducing your expenses, and pushing up your net operating income. So I would say it's a lot more controllable in those facts. And when you're analyzing the deal, looking at your financials and the past numbers are great. But if you're not going to manage it and operate it like that existing owner will, then those numbers aren't irrelevant, but it gives you a window into how the building's operating, what sort of additional maintenance and things are. But on a management side, that's where you can really control a lot of those expenses that come out.
Okay. Yeah. And like, given the current market that we're in, where finding cash flow in properties becomes a whole lot harder. When you find, let's just say on the residential side, and I totally get that, and I agree with you. The commercial side's a lot more predictable because it has less to do with comparables and more to do with the income that the property is bringing in. But like with regards to the residential side, these properties that you would be pitching or that you'd be sort of sending towards your money partners, if they do, you find at least that there are properties that you're willing to look at that might not cash flow as great, but you're like, this is a sound investment, this is a good property, especially in the long term, let's maybe put some more capital into it so that we can see it through, or let's put a little bit of a contingency fund in to be able to perhaps now with interest rates being what they are, patch up the bleeding, and once things, once interest rates drop, if they do, I think it's still going to be an awesome property. Or, this is the long-term strategy. So short term, it may be a bit of a loss, but long term it makes sense. Or do you find that the properties that you bring are purely, this is the cash flow, we just need to find cash flow in properties, put as little money as we can down so that we can, increase our ROI, or put some more money in so that we can increase our cash flow on the property? How do you find that balance on the money that you're asking them to invest, versus that cash flow, that sort of ratio there?
Yeah. Yeah, I'm definitely less of let's do as little as possible. So when I was doing it solo, I was moving into the properties and I was doing it with 5% down. So for me on the personal side, it was easier for me to do it with little and less money down, but I was also controlling a lot of things because I lived in part of the property. When I look at it from an investor side, there's I'm not living in the property, so I want to control a little bit more. So contingency funds are huge. I find that being able to have a buffer fund and like again setting those expectations right from the beginning and having that money there is way better than making that awkward phone call and say, hey, you know, we decided to go on a variable rate mortgage, and now our mortgage has gone up $600 since we just talked in the beginning, and now we got no money in the bank account. I'm worried about defaulting on our mortgage or missing a payment. So having a contingency fund from the beginning is going to save you from having those awkward conversations. So really, again, setting it from the beginning is super important. When I look at something long term, obviously we're in a point right now where rents haven't necessarily caught up with inflation that we're seeing. So it can be challenging for people to cash flow on a property today. But what we like to do is we have to look at other markets out there. We can't just focus on exactly what's happening in Edmonton's market. We have to look at outside because Edmonton typically lags behind the bigger markets. Vancouver, Toronto, and even Calgary. Calgary, call it as 6 months ahead of where Edmonton typically ends up and lands, right? So what we have to do is we say, okay, like we look at Vancouver, for example, two-bedroom apartments have gone up, call it $1,000 more than what they were before. So they're catching up with inflation a lot quicker than Edmonton is. And so you might have to deal with a little bit of a sting because right now you're also buying at a low. Like our market is down compared to when we were looking 6 months ago, 4 months ago, when things were peaking out in our spring and summer market. And so you're taking advantage of an opportunity of buying at a low. You might sit with the sting for a little bit. And when we're looking at the cash flow, it's not like negative $1,200 a month. It's breaking even or it's slightly negatively cash flowing. And we're already pushing up rents in like most of our portfolios right now on the multifamily side and the residential side. We're pushing up rents in every sort of category that we have. So you're taking advantage of an opportunity in a buying place now. You're dealing with a sting. So A, have a contingency fund, and then B, understand where our market is going by looking at other markets and then using that to kind of predict what's going to happen. So for me, I wouldn't want to be in a place where I had zero contingency fund and as low as possible, because that's a recipe for disaster when markets shift. And we're dealing with a market shift right now. And so really having all of your ducks in a row is going to help you kind of get through this storm.
I love that. I think people can take that snapshot there, and that in itself can help them put their presentation together, have some of that market data, because these are possible questions or objections that people are going to have that contingency fund for when the inevitable unexpected happens, or expected where it's sort of planned, like we will have a little bit of a loss, but once there's a market correction, things will go back to normal, and then we can replenish the fund and we can take our profits from there. I love that. And just to touch on what you said when you initially started, you in the properties, you leveraging 5% down, that sort of thing. And I know you said you sort of co-manage some of your properties, so you self-managing some of them, and then others you are outsourcing. What factors do you consider when actually deciding if you're going to self-manage or not?
Yeah, there's a lot. There's a lot of factors. So we have about 50 doors, ranging from single family to multifamily and everything in between. And we have some properties that are locationally specific, in the university area close to where I live. And then we have properties in the deep south. We have some properties in areas where I would say less desirable tenant profile. And so, really, with my time that I have allocated, I don't want to be dealing with more tenant problems and things like that. So, for me, I look at, what's my time invested in it, and is it, what's my dollar per hour, taking a look at that and saying, is it worth it for me? All the properties on our block we self-manage because it's pretty easy. We if there's a problem, I walk down the street. It's always hard to try and not let your tenants find out where you live, but so we manage that one, and my wife and I we do it together, and that's pretty easy. I mean, we have about 15 to 20 doors kind of on our block, and then we have other ones that are outside, some in Mill Woods, some in kind of like other communities. And those ones, we have a combination of using tenant placement services. And so for me, I always find the hardest part is getting the tenants in there, and then doing the showings, vetting them, all that sort of stuff. If you have good tenants from the beginning, the management part is fairly easy if you have no issues that arise. And if you do, it's typically like maintenance related, and you're essentially a middle person at that point. So for people really looking to try to cash flow properties today, that's one of the advices I have is look at managing it yourself. Even if you're an out of town investor, you know, lean on the people that have a big network, who have portfolios, and use their contacts and save some money where you can, and it can really work out. So for me, it's that. So we do a combination of self-management, and those ones are close to our home and easy to manage, good tenant profile. We have some that are a little bit further away from home, good locations, decent tenant profile. We tenant placement, and then we manage from there. And then we have our kind of apartment stuff and less desirable tenant profile. We have a full service full service property management for that.
Okay. Yeah, and with the multifamily, it's a little easier with regards to the management side than the residential. I love the strategy though. You have all not all, sorry, but you have a big chunk of your investments like right there by you. If you get a call late at night, you're not driving 20, 30 minutes to the other side of the city trying to go there. It's like right down the road. Um, and I think that's honestly that's sage advice. It's great advice that using a property management company to actually screen the tenants, get the tenants in, do the walkthrough inspection, all that stuff, and then you sort of just manage it along there, um, fixing anything that needs to be fixed, that sort of thing. Well, that being said, though, have you come across has the screening been that good that you haven't had to deal with any disputes, that sort of thing, with regards to tenants paying their rent?
Knock on wood, it's been pretty good. My first property was the worst, where I found the tenants and I had to deal with a bunch of stuff and RTDRS and domestic disputes and all those fun things that you never want to deal with as a property manager. But you set expectations with your property manager as well. You like, for us, we usually have a range of criteria, and we have the final say for the vetting. And if we don't feel comfortable with those people, we either decline, or we want to do further investigation into who they are. Just more tenant screening at that point.
I like that. I like that because it's a lot of upfront investment of your time. Doing all the showings, screening all the tenants. So if you can outsource that, focus your time more efficiently, if it's a good tenant, the time that you're putting into each property each month can be non-existent or very insignificant in comparison. So I think that's a wise use of that balance between self-managing and outsourcing. I think that's a great tip. One thing that I find a lot of our listeners like is when we run through a deal, showing them how an investor runs through the numbers, what a good deal looks like, the challenges that arise, how an investor is sort of able to overcome them and the lessons that they've learned. In the spirit of discussing raising capital, do you have a specific deal in mind that's best suited for us to go through?
Yeah. So, yeah, I'm thinking. So, I mean, I'll talk about our biggest deal, which was a 24 unit apartment building. It was right around 3.4 million dollars, and we were assuming a mortgage. And so for us, the challenge was every month that we didn't like we didn't close, there was another um, mortgage payment, and the principal pay down was, call it $9,000 a month or so, $9,000 to $10,000 a month. So every single month that it went by, so what ended up happening was we were raising capital. We had a couple people. We set a $100,000 minimum as far as an investment goes, and we really were trying to get four partners in at 250 each, and we had basically everybody set up, but we needed an extra 200,000. And we would have some people who would commit, and then they would get to the point of signing a personal guarantee or some sort of thing, and then they would back out. And so we kept trying to reset that individual and find new people. And it takes time to, get some, like, it's a prospecting, right? We talk about it in real estate. It's like you got to get people through the funnel, right? And so we had people who were getting through the funnel. They would listen to our presentation. We set it up where we had a Zoom, and we basically had the Zoom recorded, and we could send those to people. They could review the information, and then if they had further questions, we could kind of answer it there. That's how we saved a lot of our time. And one of the things that we learned because it was an assumption, we basically ran the numbers with $100,000 contingency fund when we closed. But because there were so many delays in closing, and if you ever deal with assuming a mortgage or CMHC and all the things, there's so many delays on the commercial side, it's crazy. And we basically burned through 80% of our contingency fund. So as soon as we started, it was a challenge because all of the expectations that we set with the investor kind of went out the window, because we're like, oh my God, we don't have much money in the contingency fund. Good problem to have, because all of that money is now in principal and equity, but now we don't have the cash sitting in the bank to make us feel comfortable with running this thing on a monthly basis. So right from the get-go, it was all that conversations and all those things. So that was pretty stressful. So when I analyze a deal, and especially like on a multifamily side, it's really about understanding the numbers and having a clear expectation of all the moving parts that come down to that situation. So every deal is going to be a little bit different, but one of my advice is partner with somebody or have conversations with people who know what they're doing. When I first got started, I found a mentor, which was James. And I remember when I sat down with him to go through our deals and have that conversation with our joint ventures, we took 2.5 hours of his time, never transacting a property with him, and just like asking him all the questions under the moon. So we were prepared to do that. And so I think having that team, that mentor, that coach to help you look at those deals and analyze. Same thing with a realtor, having an investor focused agent who can answer those questions, look at things that you might not think of. That's almost the most important thing when analyzing a deal, is just not overlooking some of those simple things. And for me, it was, for us, we were overlooked the principal pay down portion of the delay in closing.
Yes. I actually think that this is the same deal that I discussed with James in the previous episode, but the previous episode was on multifamily, so it's a different take to it. So we touched on a few things, but I think it's the same deal. He mentioned that there was a lot of issues when it came to the one investment partner or something along those lines. And so yeah, looking back at this deal, is there anything that you would have done differently?
Raise more money, probably.
Have a bigger contingency fund?
Yeah, honestly, like having a bigger contingency fund and getting things in order first. And, we almost trying to find we found a property first, and then we found the joint venture partners later. So again, that's kind of why my opinion has shifted, because before it's like find the opportunity, money will come, but it almost burnt us to the point where we had the property, but we didn't have all of the investors. So if we could, pool, and now like we have the opportunity to basically call people who we know has money and say, hey, we're thinking about pursuing another multifamily. Are you guys interested? Probably going to be looking at 250 to 500 as an initial investment. Are you guys interested? And so going back to my original, opinion of that is get your partners first, and then the property and everything second. That was probably my biggest takeaway, and the lesson I learned from doing that deal.
Yeah, I like that as well because when things are hot like they were like earlier on in this year, you find these deals, but they go in quickly, so if you have your ducks in a row, you have your financing sorted out, you can act on those deals and you can actually get those deals when they arise. And I like what you say is, you find the deal, but now you're looking to find a partner, and this is a long-term relationship. It's not something that you want to just rush into with anybody that's willing to give you money, and then you have all the headaches afterwards and all that friction afterwards because you guys just don't get along. So I absolutely love that, and I think a lot of people, I know initially when I thought of raising money, it's find the good deal and people will come to you, and a lot of people have that perception, but ever since speaking to James, actually, and even speaking more so to you now, it's just solidified that even further, that focus on building those relationships, find those partners, have your goals cleared up, know what you're looking for, and you can sort of present to them. You build that credibility and experience so that they trust you, build that relationship, and then have that in line for when you're actually looking for the deal. You've narrowed down your criteria. Now you can focus, look on the deal. You realtors will take you more seriously because you're able to act on the deals they send to you that meet your criteria. I think those steps just become a whole lot clearer, and if people have listened this far, it's a lot easier for them to take those actionable steps, break it down into sizable chunks, and take action instead of just going that analysis paralysis, going through that, trying to put the presentation perfect it, get that deal, perfect the presentation, and then try and go out there and find someone, and you look again and the deal's gone. I love it. Honestly, I think you brought a ton of value to this episode. I really appreciate it. Now, aside from investing, how else are you spending your time? I know you said you're a car enthusiast, you a dad, you a husband, you wear many hats, you a realtor. Um, what are you doing for fun? How do you spend your time?
Oh man. Well, right now it's just parenting. I mean, obviously that takes up a lot of time. So actually, right now my parents are here. They're looking after my little guy because he's got an eye infection, and my wife's in Montreal for work. So I'm rolling with the single dad crowd and taking care of them. So bouncing between working and doing that sort of stuff. But yeah, often for me, I'm a big family guy. Love, not just my immediate family, but my parents, my siblings. We have 4 siblings in my family, so we do a lot of like dinners and things like that. I'm a car guy too, so often on weekends or any free time, I'm putzing, trying to work on cars. So I've built an engine on an old BMW E30. I have a old school 1978 Bronco, and it's just like working on them, restoring them, enjoying hanging out and building and just spending time in the garage. And that's kind of like how I unwind. And then, yeah, just kind of hanging out with people and just spending time with people I care about.
I love that. I love that. You need that whole holistic approach to living a happy, fulfilled, successful life outside of just chasing the numbers and chasing your goals. You need the family that you can actually spend and enjoy your life with, and you need some hobbies and passions. I really want to see the E30 when it's complete. I think there's a frame, like some sort of like a picture hanging in the office with the E30, if I'm not mistaken.
Yeah, yeah. My dad got that for my birthday for he has a friend who owns a metal fabrication company, and they basically not 3D print, but they have these things where it's a big piece of aluminum, and then it's just like circles that are punched out, and it makes a picture. And so it's an E30 that they found online to try to match mine. So that was a cool present, and it's a very big piece. So I couldn't find a place, and I finally brought it into the office. So
That's definitely a classic. I'm a big BMW fan. That being said, where can listeners find out more about you? If people want to reach out to you, you are an investor-focused realtor and you're an investor yourself. If anybody wants to work with you, if anybody wants to use you as a realtor, where can people find out more about Adrian?
yeah, so probably the easiest is phone call. So I can, pass on my number or have it in
I'll
there.
leave it all in the description. Yeah.
Cool. Leave it in there. And then on our website too, you can always email me. It's just my first name. So Adrian, Adrian at mogulrg.com. So that's phone or email tends to be the best way to get in touch with me. And, we're happy to help anybody looking to, start their real estate journey, or any sort of real focused investor clients. We work with anybody who's brand new to establish and have large portfolios. We're there to help.
Perfect. Well, Adrian, I just want to thank you so much for coming on to the show and sharing. I know I got value from this episode, so I'm sure there's people out there that loved it. So yeah, thank you. I really appreciate it.
Awesome, man. Thanks for having me.
Thank you for tuning in to Building Wealth Through Real Estate. If you're interested in learning how you can scale your portfolio, then you definitely want to check out the episode where I interview James Canal. He has over 250 doors. This is your host, Adrian Nedelec, signing off.